Welcome to the Torch Academy. In this episode, we're covering what your CPA probably won't tell you about selling, from tax strategy to missed opportunities. Welcome to the final video in this series. Here's something critical. Your CPA is trained to do one thing: minimize your taxes every year. That's their job. That's what you hired them for. But when you're selling your business, your goal changes. You're not trying to minimize taxes anymore. You're trying to maximize your net proceeds after the sale and taxes. Sometimes these goals directly conflict. A tax strategy that saves you $20K in the current year might cost you $200K when you sell. Your CPA might not bring this up proactively. You have to ask. Here are common mistakes. First, some business structures are better for sale than others. An S-corp might minimize current year taxes but complicate the sale. Second, aggressive depreciation reduces current taxes but creates recapture taxes at sale. Third, deferring income year to year makes your financials look erratic. Buyers hate inconsistency. Fourth, you might owe 30–40% in taxes at closing. If you haven't planned for that, you're shocked. Fifth, mixing personal and business expenses confuses the financial story. Sixth, taking huge owner distributions some years and small amounts other years makes the business look unstable. These decisions made sense for tax purposes, but they hurt the sale price. Here's the timeline for tax strategy. 18 months before listing, consider whether you'd benefit from a tax specialist, someone who specifically advises business sellers, not just business owners. They think differently, and if tax strategy isn't your forte, they can add real value here. 12 months out, start adjusting your income and deductions for consistency. Smooth out the lumpy years. Make your financials look like a stable, predictable business. 6 months out, your financials should show that stability. At closing, execute the actual transaction in the most tax-efficient way. Maybe that's a stock sale, maybe it's an asset sale, maybe there are earnouts. Your tax specialist advises on this. The difference is important. A traditional tax minimizer CPA focuses on reducing your current year taxes. Every year, they're trying to defer income or maximize deductions. That's not wrong, but it can create a financial picture that looks erratic to a buyer. A sale preparer CPA thinks differently. They're trying to balance current taxes with what helps your sale. They want to show stable, consistent income. They use structures that work both now and at sale. They plan for the tax hit at closing. They advise on whether a stock sale or asset sale is better for taxes. These are different skill sets. Real example. Dave owned a business worth $2 million. His CPA had minimized taxes for a decade. Very aggressive. Short-term capital gains treatment, depreciation recapture, everything. When Dave sold, he got $1.6 million in proceeds. But the tax bill was $600K. Depreciation recapture, short-term capital gains taxes, all the stuff that was deferred. Net to Dave, $1 million. If he'd rebalanced in the 2 years before the sale and taken a different transaction structure, his tax bill would have been $380K. He'd have netted $1.22 million. The aggressive tax minimization cost him $220K. That's the paradox. Bring these questions to a CPA, yours if you have one or one you're considering. 1. Do they actually advise sellers or just do tax prep? You want someone with experience. 2. What tax strategies should change as you prepare for a sale? 3. What's your likely tax bill? They need to project this. 4. Should you restructure your entity? This is complex but important. 5. Who else should be on your advisory team? Lawyer, advisor, valuation specialist. A good CPA knows the answer. Here's my final advice. Selling a business is complex. There are tax implications, legal structures, valuation issues, negotiations. You don't have to figure all of this out yourself. If tax strategy or legal structuring aren't your strong suit, bringing in specialists, A business attorney, a tax advisor who works with sellers, or a valuation expert can add a lot of value and confidence to the process. It typically costs 10 to 20K upfront, but it can save you 100K to 500K through better strategy and structure. That said, if you're comfortable in these areas and willing to put in the research, you can absolutely handle parts of this yourself with the right tools. The key insight: the tax strategies that save you money every year can actually cost you money when you sell. Years of aggressive write-offs make your earnings look lower, which means a lower valuation. If these areas aren't your strength, advisors who understand both sides, tax efficiency now and sale optimization later, can make a big difference. The ideal time to start exploring that is 2 years before your target exit date. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.